Hi everyone. We are just waiting for a couple of people to filter in. But thank you all for joining us this afternoon. But yes, thank you for joining us. Great to meet you all. I am Holly Hudson. I'm community lead here at VenturePath. And the gentleman you will see alongside me is Ian Merricks, the founder of VenturePath. So yes, thank you for spending your Tuesday lunchtime with us. This is our first virtual event of 2025. And today we are going to be focusing on everything to do with scaling, particularly looking at business readiness and investor readiness and how they are great indicators of how do you know when the timing is right for you to scale. I will be handing over to Ian, who's going to host today's session. But before I do, I just wanted to share a little bit more information on VenturePath and why we exist. So VenturePath is the scale-up investment community for UK-based tech founders, and we help companies to become venture-backed successes, essentially helping them in two ways. So the VenturePath community provides growth-focused support, which is delivered through the likes of on-demand content, like you are experiencing today, regular events, but also through one-to-one strategy sessions. And all of the content within the VenturePath community has been designed by those who've been there and done it before. So through exited founders like Ian, by scale-up experts who focus on areas such as sales, finance, marketing, legal, but also through our VC network. So the organizations who have opted in to be involved and meet you guys before you're ready to raise funding so that they can share insights and advice with you and begin building those relationships before you're actually ready to go on and raise that funding. So in addition to the growth support, we also offer intensive investment support. So this is end-to-end, and it ranges from supporting with your investment strategy and getting refining your proposition, right through to documents, the outreach process, right through to completion, negotiation and completion too. So the team of the investment team are all founders who've been there and done it and kind of lived through that experience. So they kind of understand the value of having somebody who can guide you through that process, but also the value of having a spare pair of hands to alleviate some of the heavy lifting involved in a fundraise. So that's enough from me for now, but I will hand over to Ian, who's going to host today's session. The Q&A is open, so if you've got questions as we go, please put them in the chat box and Ian will address at the end. But yeah, thank you all for joining us, and over to you, Ian.
Thanks, Holly. Hi guys. So the focus today is on scale-up readiness. So I'm assuming that the audience is kind of founders of UK-based tech or tech-enabled businesses, where from a scale-up perspective, you're on a journey of maybe 1 to 10 million revenue, or certainly heading towards that. So that's kind of how today has been focused. The reason I mention that is because at different stages of your journey, in different geographies and in different sectors, some of the advice might be a little bit different, but this is the kind of core of what we're trying to present to you today. So why is this important? Before we do that, let me tell you who I am. So Holly's done a great job of introducing VenturePath. I'm a founder of VenturePath. It is the scale-up investment community. So everybody that we work with is either a scale-up on the journey, somebody supporting a scale-up on the journey, or somebody investing in a scale-up on the journey. So we've quite an enjoyable working week dealing with highly ambitious investors and entrepreneurs. My own background prior to all of this was I built 3 businesses, and I raised all the different sources of funding you could imagine along the way, from bootstrapping to seed funding, grant funding, VC funding, corporate venture, etc. So I kind of figured out quite a little bit on my own journey, and I've also kind of been in the tricky seat of steering a business through as it scales, and maybe that sort of empathy with the stage that you're at today. My mission now is to create more venture-backed UK tech successes. I'm a passionate believer in the UK's ability to lead the world in the tech businesses that we are building, the innovation that's created, and the investment that backs them. There's always more work to be done, and I spend a lot of time kind of thinking and talking and complaining to government and the likes about how we could do this bigger and better. And all of that experience, both the sort of understanding of today's venture landscape and my own background building businesses, it's kind of been channeled into this objective and the work that we do within VenturePath. And so, as you can then imagine, within VenturePath, it's often difficult to kind of visualize before you've become part of it. There are tools and templates, techniques to help you scale your business. There's a raft of content, hundreds of hours of digital learning modules, and access to a community of fellow founders, to the experts, to the investors, and support, importantly, and guidance and consultancy from our team and our expert network to help you achieve this success. But where it's all come from is about the UK is good at it. Tech is an absolute enabler, an absolute leveler. The investment piece is hard and difficult when you're unlocking it the first time. It gets easier the more times you've been through various funding rounds. I've been through £700 million worth of those funding rounds across about 80 companies. And that's kind of what's driving some of the insight I'm hoping to share today. And along the way, as Holly already mentioned, we've invited in £10 billion worth of VCs to be active members within VenturePath. And those VCs are involved in the content, involved in the guidance and feedback, and ultimately involved in investing in the scale-ups that we are working with. So 2025, here we go. We are 21 days in, 3 weeks in, and already the world is a very different place. So I was trying to summarize, I do lots of these talks. I was trying to summarize kind of what's different today, what's different in 2025, what's going to make the difference. And I would probably summarize it with the words at the bottom there. We're in a global landscape. I think thinking about building a small UK-based parochial business with UK customers, UK distribution is maybe okay at seed stage. Good proof of concept, helps you find product market fit, helps you achieve those kind of early proof points. But it isn't what's needed to really scale where we're looking at a sort of global environment. It is underpinned by change. It isn't just about kind of being aware of things that might change. It's that we're experiencing daily structural change to the way that business is done, to the way that tech is built, to the way that businesses are growing. So really thinking through the fact that change is a constant, and never has that been more true than right now. Tech and AI particularly is obviously a game changer. It's driving the momentum of the change that we're seeing, and it's not a surprise that the screenshot on the right from yesterday was kind of pretty relevant, right? The people who are most involved in things like the inauguration are all tech and have built big tech businesses, all of whom have got AI at the forefront of what they do. And the reason for all of this, if we try and make sense of that, is because that's where scale comes from. So the ability to create a very large business that is able to embrace change, that is tech enabled, probably has got a good, clear AI strategy and is global in its outlook. That's the way to create scale. And why is that important? Well, because if we're talking about scale-up readiness in 2025 and the investor readiness that's kind of implied by scaling quickly, then having a firm grasp on where your business sits against these sort of key pillars is really key. So what we think the scale-up piece of that looks like, and I'll come back to the investor readiness in a moment, but the scale-up piece we think looks like this. That there are key things that you should be able to track within your business. And for this part of the conversation, I would probably pause on worrying about what everybody else is doing. I think this bit is a little bit more inward, introverted reflection. So are you building your business to the stage that it is able to scale in 2025? And I would put at the top of that checklist, if you like, the team. Have you got it? Are you building it? Can you supplement it? And that's super important. Team is always pretty much at the close to the checklist, the most important things to feature. But I would say right now it is the absolute most important thing. The ideas are plentyfold. There are lots and lots of ideas, as there always have been. There are 1 million new businesses incorporated in the UK every year. And the tech, I think, slightly controversially, but tech is becoming commoditized. So having the tech to underpin a business has become cheaper, has become more accessible. So actually, the differentiator has to be the team. And so have you got the dream team to build your business in 2025? If you haven't got it, what steps are you making to building out that team? And being creative, how can you supplement the skills that you've got? Maybe that's consultants, advisors, board, partners, that kind of thing. The team's strength will help with all of the rest, which is why we started there. And the other areas that then you might want to think through are sales and sales predictability, sales satisfaction, customer success are really things that we're seeing, the VCs that we're working with on a weekly basis, really, really drilling into, perhaps in a way that they haven't analysed in quite as much granularity in the past. But now they're really, really fixated on what's the sales look like, what's the composition of the sales, what's the pipeline, what's the conversion, what's the timescales, what's the uptake, what's the upsell, and those sort of sales metrics and sales data are really important. Now, obviously, sales predictability, holy grail territory, that's one of the hardest things to achieve in a business, right? You don't really know month to month what the numbers are going to be, but the more you can do to take risk out of the equation for your business, ignoring investors again for a second, but from your business, to be able to understand that you've created a level of stickiness, an element of recurring or reoccurring revenue in what you do. So it isn't just the case that every first of the month starts again at zero, and you've got a battle to climb. And that is about kind of beginning to highlight within your business to your stakeholders, maybe to investors, that there's a flywheel effect, that you've got momentum, you're able to harvest demand, you're able to convert interest into action, into sales, and you're able to convert sales into more sales and sticky clients. And that is how that business begins to build. And that might be different from what you've experienced to date. So perhaps if you've had the experience of getting a business from Peter Thiel's 0 to 1, from that early stage of launching it, bootstrapping it, and exhausting your contacts, that sort of founder-led sales approach of 0 to 1 million is absolutely fine at that sort of pre-seed seed stage. But the scale-up phase requires something different. It doesn't require every next day to start at zero and you having to do all of the hard yards yourself to do it. It's about creating an easier access to market. Maybe it's a channel sales strategy. Maybe it's that the learnings that you've achieved at your seed stage have helped demonstrate now that you're able to improve the customer acquisition metrics, that the marketing's more targeted, that the partnerships are completely on brand and on message. Now, this obviously crosses over sales predictability, and the data and metrics around that obviously crosses over with the third Scaleup Readiness tip, which is about financials. And so within your financial modeling, your financial forecasting, being really, really clear on the growth metrics is key. So not just that we're going to double and double again, but really linking that back to where the business is, where you're trending, what last month looked like, what last quarter looked like, what year-on-year trends look like. And so having clear financial models that act as both a snapshot of the business and its trading to date, and then the immediate and longer term forecast going forward. A big chunk of that will be aided by you including the assumptions in your financial model. So what is it that's driving the financials that you're putting together, and where possible, link that back to facts and data and proof points that you already have in the business. So in English, for example, that might mean that at the moment, our average order value is 200k a year. We are intending for that to grow. We think that that can be done because our customers have told us if we added X, Y, and Z feature, they would be prepared to pay more. Where we've and the more you can do to build out that assumption, the better. So we have a number of these clients, several of them are now in proof of concept for the extra functionality on a paid trial basis. You see how you're beginning to add layers into your growth metrics, that it isn't just a hoped for, we would like our sales to be more, but it's a bit more strategically thought through, that the sales growth is building on the predictability that you've already begun to prove in your business. And those unit economics That is your cost of customer acquisition, their lifetime value, the average order value, the churn factors, being really up to speed on all of those. If you're not, it's definitely going to be a weakness, because these are areas that VCs are particularly close to. There are areas that you absolutely will be able to impress, browbeat, surprise, win over your potential investors. But in the financial metrics, that's definitely the area they spend all of their time, most of their time. So it's something you have to be kind of up to speed on. So then operations, and within that, I'm including product, so the tech and all of the things that kind of help your business run. Product plans, absolutely, is always kind of an area that you would need to be clear on in a tech or a tech-enabled business. So what have you built? What needs to be built? How are you going to build that? All pretty clear things. A tip there around 2025 is the greater ability to link the product development plans, product roadmap, back to your customer demand. So anybody could build product, but the fact that your edge is because your product development plans have been greater informed by customers or prospects from your sort of daily interactions with them. And we can't miss in this sort of AI powered theme of the start of 2025 that you've got to have an AI strategy. Now, your AI strategy might be, we're not going down the route of AI. We don't have a big pool of computer scientists and engineers, in which case you need to be able to communicate, and I'll come back to this communication theme. You need to be able to communicate why you can build a venture scale, a scalable business without an AI strategy. What's AI doing to the market, and how does that create a threat or an opportunity for your business? And it might be that you've got some embedded sort of off-the-shelf AI in there, but from a competitive differentiation perspective, remember, probably everybody will have. So there's kind of an entry level expectation, which I think is coming of age in 2025, that all businesses will have an element of AI empowerment going throughout them. But is it your competitive advantage, the AI? In which case, where's the tech team to underpin that? And if not, how does it just keep you kind of future proofing your existing business? And then I'm making a big assumption, but that's because I do spend a lot of time with scaling companies and their investors, that your scale up plans at some point will require investment. It's very difficult to bootstrap to 10 million, 20 million, 50 million revenue. At some point, a lot of businesses will take on equity investment. So within that, some of the stats that we've done some research on in 2023, in 2024, I was going to say last year, but that is 2024. In 2024, we saw a lot of data. We analysed the 2,179 companies that access seed funding, and we analysed the sub 250 companies that access Series A, so first VC checks, 2 million plus individual check sizes. The stat that leaps out of that is that 9 out of 10 seed funded businesses are not accessing VC funding, which means the competitive environment you're going after, if you're looking for VC funding to grow a scalable venture-backed business, is you've got to be the 1 in 10 that wins. And so because of that, being super clear on your points of differentiation across the whole business, across the team. We've got the best team. They've got great experience. We're supplemented by a fantastic board, and they've built and exited businesses like ours in our sector, is a good answer. Building out that competitive differentiation across sales, again, you can see how that reinforces the fact that your seed journey to date, your early Series A perhaps, has got you to a point that you've got a greater degree of sales predictability. You've got greater customer satisfaction than your peers, than your competitors. That your financials are underpinned by really clear assumptions that take risk out of your scale-up goals and objectives, and that your product development plans are wholly customer informed. And all of that is a way for you to be the winning business not just winning in terms of customer acquisition, not just winning in terms of tech, but winning in terms of winning the investment backing to get ahead of the pack, and really double down on the growth that you're aiming for. Related part of that differentiation is the defensibility. So back to, if I'm suggesting that one of the key themes for 2025 is that change, and that change is a constant. This isn't just about differentiation today. This is about defensibility in a market where your competitors are becoming super skilled, turbocharged, AI enhanced, and going after your market. What's the defensibility strategy as the market continues to grow momentum? And that is a slight nuance, slight variation on differentiation. Easiest way to think about that is, how have you future-proofed your business today, and how are you future-proofing the business tomorrow, when you know that the market that you're in, the dynamics that you're facing, are ever evolving. Okay, so they would be the 5 key areas, I think, for you to kind of really think through and track your business based on how well you're performing in each of those areas. We at VenturePath provide expert guidance grouped by these 5 themes, and at the end of this this session, we're happy to share with the participants a short link which will give you a score based on your scale-up readiness against each of these 5 themes. And if you score low in any area, of course you won't, but if you did score low, we give you some guidance and tips to help improve in each of these areas: team, sales, financials, operations, and investment. There's some video content, there's some signposting to resources, all free and all accessible by completing your scale-up score, which takes about 10-15 minutes. So might be a useful thing to kind of check that you're scoring well in each of these areas, or any areas that you could do with a little bit of extra help, begin to get some pointers in those areas. Okay, so moving on to investment readiness. And this is, again, because, as I've mentioned, we see this as being a pretty symbiotic relationship. You can't raise investment unless you've got a clear scale-up plan. You can't really scale up without investment. It doesn't always have to be equity investment, but that's the most common form. And we know that there's 10 billion of ready capital available for UK tech-enabled businesses at this Series A to Series B phase of their journey, because they're part of our community. Outside of those investors, there's another 1,300 or so investors across the UK and Europe willing to invest 2 to 20 million checks in scalable tech-enabled businesses. So the money's out there, and we, from our experience, know that often realization of your scale-up goals is unlocked by accessing the funding. So how do we do that? Let's first of all think about the role of funding, VC funding, particularly equity funding. It's not about providing a working capital facility. It's not about you taking money off the table initially, and it's not a rainy day fund, the equivalent of an overdraft. This is to fund explosive growth to a 5-ish, maybe 5, 6, 7, but talk about it in a 5-year horizon, a 5-year exit, and a minimum return for the investors of any money that they put in. They want to see 3, 4, 5 times as a minimum. They want to really see a path to 10 times, and some of them are looking for a much greater return than that. Now, all of that is requires you to be able to communicate that your business represents that moment in time where capital, their investment, will unlock massive growth. Not some growth, not incremental growth, but explosive growth. And that growth will lead the business to the point that in 5 years from now, it's a much more attractive target for a number of potential buyers, and they will pay a heavy premium to the business's value today. And that's how to think about that sort of first bullet point. And if you can get your head around that, that is a good insight into the sort of VC's mindset of what they're looking for. And once you've understood that, that helps you tell your story better, so that your scale-up goals play into that moment in time where there's an opportunity for explosive growth, where you're going to create a business that is much more valuable to known potential buyers in the future. The investors that we're talking about will invest particular amounts. We write £3 to £5 million checks. We write £5 to £10 million checks. We write checks that are the first check or the last equity check in a round. We're pre-IPO focused. So all kinds of jargon that goes around that. But it's easy enough to understand with a bit of research which VCs are investing at which stage. And not many VCs blur the lines. And part of that is because they've told their investors, the people who've entrusted them with their money to invest in scale-up companies, that they are only going to invest at Series A or at Series B or at Series A and B or at late seed into Series A. So there's a point there where there's a consistent stage, and that has already been agreed by the story they've told their investor, which is basically called their thesis. And their job day to day in the VC isn't to solve your cash problem. Their job is to create a return for the fund. And because of that, they're looking to back the right team. There we are, team featuring as one of those first measures, with good, strong revenue growth to demonstrate the market potential to be venture backable. So if you're already in a sort of slightly downhearted, downbeat, apologetic approach of, I know sales haven't been that great, but it's been hard and difficult, but with your money, it's going to become, now all of a sudden, it's going to become a much stronger, faster growing business. You could see why an investor would be a bit more skeptical. So you've really got to get that kind of sales engine working before going out to market at the moment. Now, if you'd have asked me 4 years ago, I might not have laboured that point. But right now, we think that kind of sales momentum is key to most VCs' assessment of a business and its ability to deliver a venture-sized return, that 3 to 5 to 10x return that they'll be looking for. And the bar has got higher, and I don't think it ever lowers. So all of those 5 themes that I mentioned in the earlier slide around scale-up readiness, the team, sales, financial, operational, and investment readiness are kind of now entry level. I don't think they are nice to haves. Actually, you know, we're pretty good at sales, but we haven't got a strong enough team. But you know, with your money, we hope to go and find some team members that will supplement this. Isn't a great answer. You've kind of got to be really good and fully formed. Now, I get it. Right? As an entrepreneur, that's hard and difficult, right? Particularly if you're in any way under-resourced, a little bit constrained on what you can do. And that's where leaning into the support network like VenturePath, like Holly's expert network and the community there is really key, because it can get you further forward in each of these areas without necessarily having to spend lots of money to achieve these additional proof points that VCs are requiring. And the VCs are looking for all of these things to come good. And the reason for that is because internally, whoever your champion is within a particular VC firm or firms, they've got to get to a consensus. They've got to get to a point where what they can see in your business is the best use of their capital against all of the competitive opportunities that they're looking at. I spoke to a VC yesterday who said, we're unable to give, I said, we were talking about giving companies feedback, and they said that their admission is that they can't give all their companies feedback because they're approached by 2,500 companies a year. Right? This is a fund that's backing 30 or so deals a year. So the numbers are absolutely skewed. You've got to put yourself in the best possible position to be the best use of the VC's capital, and to be the deal that they want to take forward, to be the 1 in 10 seed funded, not seed stage, seed funded businesses that make that leap to Series A. And then the drop off rate from there is again only around 40% of the companies make the progression from Series A to Series B. So if you want to be at that forefront of building a global game-changing potential business with venture scale in 2025, you've got to be able to deliver on these proof points. Okay, so that then gets us to the investor readiness piece. So we've talked a little bit about kind of what investors want. So what can you do to kind of play into that? Three themes here. One, work through in advance internally your investor proposition. What's the valuation you're planning to go out to market for, and why? Not just ego, is it? You know, we think we're worth 20 million, we think we're worth 40 million. But you know, what's the step change that you've achieved to take risk out of the business since its last post-money valuation? What does that look like in terms of competitor fundraisers or exits? as a multiple of your current revenue. If everybody else in your industry is trading at 10x and you're asking for 20x revenue, doesn't that instantly make you look overpriced to a VC who's got access to all of that kind of benchmarking data? How much are you looking to raise? Is it fit for stage? Is it fit for purpose? Are you raising too little? You're not going to actually be able to make a dent in the market that you're chasing, or build a sufficient product, or maintain a high enough quality team? Or is it too much money that therefore implies too high a valuation for the proof points that you've got in the business today? The best measure of that is speaking to people who are active in the market about what does normal look like, because there is a norm to this. And raising 6 million as a Series A versus 4.5, raising 5.5 million versus 4.5 million is a different number. Not least of which because things like VCTs have a 5 million per annum rule. So raising outside of parameters that you might not have been aware of can really put you at a disadvantage. Whereas kind of tailoring your ask and your valuation to the current thinking, current active areas of the VC landscape are a way of making your message resonate better and faster. Think through the multiple. So I've already kind of touched on this, but not only the entry multiple, but the exit multiple. Do some research on what businesses like yours are typically acquired for, sold for, and how does that link to your entry multiple, and what therefore would be the implied return for a VC if they're buying a say 20% stake in this round for their 5 million. What's that 5 million 20% stake going to look like if your business achieves a 10x industry standard multiple, whatever your number is, of your year 5 P&L revenue line? So do a little bit of work there to just make sure that you don't fall over on the basics of an investor proposition. From a readiness perspective, think through the things that you can get ready in advance. And we would suggest that investor documents are a massive feature of that. I've worked with over 1,000 startups as they go on their growth journeys and their investment fundraisers, right the way from seed to Series B. And I do quite often hear a lot of complaining about investor documents. Does anyone read it? Do we even have to do it? I heard about somebody in Silicon Valley, and they raised off a napkin in a diner. So all of that I just take as absolute nonsense. And yep, you might be lucky and be the single business that achieves that goal without being properly prepared. I would rather you were properly prepared and therefore more likely to be in the majority of businesses that have prepared this information for their investors. What's needed? Well, business plan, pitch deck, financial model, and a data room. And then probably some marketing documents like a front-end teaser or exec summary as well. Now, business plan is detail. It isn't just a pitch deck. If you're asking an investor to write you a check for £5 to £10 million, they're no longer going to be impressed by 10 or 20 slides that you flick through while you tell a convincing story about your vision. They're going to want to get into the detail of unit economics, customer churn, staff recruitment, management incentive packages, impact on the EMI option schemes, that level of granularity that is in your head but needs to be distilled down into a clear document that a VC can make an assessment from and make some reliance on. Your pitch deck, or decks really, are about having an entry deck, the opening conversation, and then a deeper dive deck. And you will probably find that you're changing the order of slides, you're changing the narrative slightly, you're dialing up and dialing down different slides based on where the questions are going and different investors' appetite and areas of focus. The data room is about making sure you've got all of the key information that an investor would need to see post term sheet, post to the point that they've agreed to become your investor. Let them have the confidence of your financial, your technical, your legal, your operational, your commercial data across the business, customer contracts, employment contracts, the IP and assets that you own. All of these kind of things are useful to get ready in advance, because it's absolute certainty that your investors will want to see that during due diligence. You don't want to be producing that while you're trying to run a business and close a funding round. So you can get ahead, and within Venture Park we provide templates and guidance on each of these areas. And importantly, I've skipped over financial model there because I think financial model in its own right has a slightly different job. It's not just to tell the story, it's also about reducing the risk or conveying to an investor how you're managing your risk and therefore their paid for risk in the business. And so thinking that through and linking your forecasts to where there's risk and how you're going to be future proofing the business, how you're differentiated, and how you are making it clear that you've taken risk out of the equation by the learning that you've already banked into the business, and ensuring that that comes across in the forecast is absolutely key. This piece about ensuring things come across is just another way of saying communicating this well. And so this communication piece is about communicate your plans, yep, your vision, but your plans more specifically, how we're going to get there. This is what we're going to do. This is what we're going to find out. This is what we need to be true in order to achieve our scale up outcome. These are the challenges that we've identified, some that we know, some that we don't know, but that our team are able to guide us on, our wider team, our expert network, our advisors around us. And then beyond that, the mitigation for the challenges that you can see. And the implication there is that the team's experience will mitigate the challenges that you can't yet see. And all of that, come back to this common theme, all of that reduces risk. And in a market where 9 out of 10 seed funded good businesses are not accessing VC funding, your ability to communicate how your business creates an extra edge and has reduced risk for an incoming investor is absolutely key. One of the big things that's going to be the difference between a yes and a no. So by preparing all of this information in advance, and I mean as quickly as you could start this today. There's no reason you couldn't begin to start populating a business plan template today, that you couldn't begin to be thinking through your ask and whether it's 3 million or 13 million and what the implications are of that. And that all of these areas you could be preparing in advance. And by doing that, you find that when you do go out to market, you're able to move much more quickly versus going out to market, being asked for things, going away and preparing it, presenting it back one at a time, and a sort of much messier, more distracting process as a result. So then, in terms of some tips around investor outreach, it's really useful to map the investment landscape. So who are the investors that you're going after? Why should they be interested in your business? Remember, their job isn't to back you. Their job is to back the winners, to back the businesses with the most risk mitigated opportunity that aligns with their thesis, their goals. Plan how you're going to reach those VCs. You know, I would absolutely say cold introductions to VCs, despite what you may sometimes read on social media about we're open to cold intros. I've not seen them work. Almost, I can say almost entirely across 80 plus deals that I've worked on, none of them have ever been cold outreach to VCs. There's kind of no need in this connected, networked world. Somebody you know who knows you and can vouch for you will know an investor that you want to know. And if not, then you need to expand your network to those kind of people who can make those warmer introductions. Think through, have you got an alignment with what the VC is looking to back? Have they already backed businesses that are too similar to yours? And what's their likely return profile? Are they looking for unicorns? Are they looking for 3 times their money on a tax efficient basis? Very different shape of the business. You should know from your forecasts whether what you're proposing is 100 million exit or a $1 billion exit, right? Is there a value add that you're looking for beyond the money? Do you need that investor to do other things for you? And remembering against all of this, it's a competitive landscape, but also it's competitive for VCs to get into the right deals. So by mapping it appropriately, by thinking through how you're going to get those conversations going, by presenting your business as a business that aligns with their goals, and by talking through the value add beyond money, you're able to identify to the investor that yours is a well-fitting, well-prepared business that is not only going to win in your own vertical as a competitive advantage for you, but could also be a win for them backing you. So it's kind of that dual aspect of it being competitive on both sides. And we would absolutely recommend that here in January 2025, if you're looking at raising money at any point in this year, and that might be closing it, that might be starting the raise, that you should be building or ideally leveraging existing relationships now, because they take time to nurture relationships. And by focusing on that keyword of relationships, that's much more important than transactions. Transaction is the outcome. Relationships is the journey to that outcome. And by socializing more with VCs, by having those early conversations with warm and engaging friendly VCs, getting that early feedback, you're putting your business in the best possible place, that when you are absolutely raising money, it becomes a selection decision for you rather than a desperate chasing goal of we need the money. It now becomes, who do we want to back this scale up that's going to take up the majority of your life and time and thinking for the next 5, 6, 7 years. Kind of want the right people in your corner. And as we come to the end, and so then happy to field any questions you might have, but as we come to the end, it is difficult, right? We're talking about running the business, doing all of this extra work to be scale up ready and investor ready, and then attracting VCs. So how can you shortcut that process? Well, you can get prepared in advance. You can learn from founders who've raised recently, and you can build the support and advisory team and functions around you. And by doing that, that makes it much more likely to succeed and much less painful as you do it. And essentially, that's what we've spent the last 2 years building VenturePath to do. It's about giving you rolling, so on-demand business advice and fundraising support when you need it. It's about surrounding you with a community of founders who are on that similar journey, and experts and other partners who can help fill gaps in the business, either short-term or long-term. And all of that sees you create a business that's better prepared to scale, probably with investment along the way. And that day-to-day work that we do with the companies sees us working through their venture strategy, the venture readiness, and the venture deal making. That's kind of our piece. The VenturePath community, in conclusion, is available. Our business model is a success fee if you need extra help on the fundraise and you ask us to help you with that on a one-to-one basis. Mark up your business plan, sit down with you one-to-one and work through your investment strategy, that kind of work. We charge a success fee on funds that we help you raise. So that's kind of our business model. You can access the community for free through participating in the Scaleup score. So by entering your information about where you are, not only does it give you some useful tips and pointers about how to be more scale-up ready, it also gives us a good idea of the business you're trying to build and helps us determine if and how we can best help you. So that's hopefully some useful tips for January 2025 to kind of you to be thinking through how to build a really successful global business in a changing market, and a scalable business that's maybe able to attract VC funding as well. I hope that's useful. If it's prompted any questions, I'm all yours. Over to you, Holly.
Brilliant. Thank you, Ian. That was great. I've just put a note in the Q&A. If there are any questions, please feel free to pop them in there. A quick addition to Ian's close, he mentioned the Scale Up score. That's accessible through our website, but I will also make sure to send it in a follow-up to everybody who RSVP'd and joined today so that you've got access and can kind of complete it off of the back of today's session. But yes, any questions, feel free to put them in. Otherwise, Ian, I'll jump in with one that I know we get quite a lot otherwise, which is around timing. And so you've talked about the benefit of preparing documents and everything up front, and the fact that that can help you move quicker during the process. But how long are you seeing that it's actually taking founders to raise at the moment?
Yeah, end to end, it's 6 months for a VC fundraise. And there are a few variants to that either way. I mean, obviously, it could take longer if you're not as prepared. It doesn't often take much quicker at the moment. So that point about the bar being raised to a higher standard means that the investors aren't rushing in. They are doing their diligence. They're making their mind up very carefully. That might take 6 weeks initially to get them to the point that they've kind of built some consensus around this being the deal they want to take forward. to building some conviction that this is a good deal that matches their fund goals. And that first 6 weeks might look like covering 3 key meetings around kind of an introduction, a deep dive into their questions, and a follow-up in terms of deal structure. And along the way, that's probably going to involve some spin-out meetings around sales granularity, pipeline review, conversion data, that kind of thing, and technical assessment, product roadmap, being reviewed by people with kind of good technical skills, particularly in an era where the tech is getting deeper or harder. So all of that being condensed into 6 weeks times multiple investors kind of hints that you, the company, you, the founders, have got, when you do go out to market, you've got a very busy 6 to 8 weeks ahead of you, because you're going through that 5-stage meeting times 3, 5, 10 VCs, plus a bit of kissing frogs at the beginning of still qualifying investors that maybe aren't quite right and fall over after a first meeting or after a second meeting. So there's 6 weeks of the process. Then negotiating the term sheet, feedback from your advisors, from your lawyers, from your board, consideration by the founding team on kind of what feels right. Easily another week or two there. So you're 2 months into the process. Most VCs then look for 3 months of due diligence exclusivity while they produce the long form documents, your subscription agreement, shareholder agreement, changes to the memorandum and articles of association that govern the company's activity. And we're not seeing that being much less than 3 months, 90 days. And then we usually try and allow a month for contingency. What gets in the way? If you're looking 6 months from now, you're getting into June, July, might be holiday season starting. We've just come off the back of Christmas. That's slowed down. There were no deals done and completed between end of December and 3 weeks into January. So that you can see how that's kind of a 6-month process if everything goes well. The way to make that only 3 months of absolute distraction while you're in pitch mode, and then 3 months of partial distraction whilst you're in kind of completion mode. The way to make that only 6 months of distraction is to go through this getting prepared phase up front and shrinking the list of VCs based on qualifying through relationships the VCs who are going to be most suitable to your business, so you're not wasting too much time talking to investors who you don't match their thesis, you don't match their life stage, you don't match their check size, for any of those reasons that you would otherwise find that they're not a good fit. Now, the annoying and frustrating thing, and I raised my first round into my own business 21 years ago now, is that VCs don't tell you this up front. So they're quite happy to take a meeting and learn a bit about your industry. It's easier than reading a Gartner report to have a founder come and tell them all about your version of the industry, insurtech, adtech, martech, deep tech, whatever it may be. It's all interesting. Doesn't mean they're going to invest in your business. So you kind of got to be a little bit careful about donating too much time to educate VCs versus achieve the goal that you're after, which is to raise money to fund the business development plans that you want to create a real scale-up success and make the impact you want to achieve with your business. So I think that's definitely worth thinking around, is that it won't always be the case that an investor will take a meeting because they want to invest in your business, but they don't always say that. So it's something to be careful about, because that's where we will sometimes see companies that we meet as they come into the community might have already been on the funding trail for a good few months, slightly dejected because they're not getting the right responses. We might have a quick glance at who they're talking to. It'll be a scattergun from seed to Series B investors, UK, Europe, US, investors with a 3x return profile and a 100x return profile. You could see that not every business would be suited to that scattergun approach. So being prepared and having a much tighter shortlist of investors to go after are ways to keep it at only 6 months distraction, and ideally not longer.
Brilliant. That's sort of linked to one other question, actually, which was around balancing growth while you're in a fundraise, especially if you're looking at sort of a 6-month window. I guess, what's your advice to founders who are trying to balance both at the same time?
Yeah, I mean, it's horrendous, right? So you will lose out on sleep, and it is a very busy time. More usefully, let me give some tips and pointers on that. Outsource what you can, delegate what you can. So by delegating to the team, by sharing with others in the team that, look, I'm going to be focused on this These are the goals. This is the objective. We're going to be raising this cash. It's going to enable us to solve some of the bottlenecks in the business, to hire in the good people that we need, to build out product, to develop more in the sales and marketing side of things. But because of that, it's going to mean that some of this stuff needs to sit with you and not back with me. That's a good way of kind of creating a bit of space proactively. The other is just shortcut the whole process. Outsource, use. I mean, obviously we're biased, but use initiatives like the Venture Path as a scale-up investment community to get prepared, to use templates and techniques that have been proven to work time and time again before, rather than try and reinvent the wheel. Don't necessarily waste your time Googling for advice and tips. You can speak to funded founders who raised their Series A, Series B within the community in the last 6, 12, 18 months, within your sector, within different sectors, and get useful insight and the ability to have conversations from the get-go with VCs who can give you an honest steer. All of these are ways to help mitigate the distraction of a fundraise, to make it a little bit more targeted, a little bit more likely to come good, and for you to have the visibility of an interest building in around and around being able to close sooner rather than later, because all of that is otherwise not only a distraction, but it's also quite stressful. So I think the more efficient you can be at preparing, delegating to the team, and outsourcing certain aspects of the fundraise, leveraging other people's experience is definitely going to be helpful.
Amazing. Look, I think we'll leave it there unless there are any more questions. But thank you everyone for joining today. I, as mentioned, will follow up with everybody after the session. But if there are questions we didn't cover or you think of at a later date, both Ian and I are around and on hand. So yeah, we thank you again for joining us and look forward to seeing you at a later event.
Great stuff. Good luck, guys. Thanks. Thanks, Holly.
Bye.
Bye.